Hello everyone, you are watching Sahab Academy. If you like our videos, then please subscribe to our channel and also hit the bell icon for the regular updates, and also follow us on Instagram, Sahab Academy. Now let's go to the video.
Hi everyone, in this video we are going to discuss the basic concepts of accounting. What is accounting, how do we do this, why do we do it, and what is the process of accounting, and what is debit, credit, and all these basic things we are going to see in this video. And this video is especially for the science students who come from a different background, right, other than the commerce background students. And this is a very simple and straightforward video, so please make sure you watch this video till the end to understand the whole concept of accounting very practically and logically, right? Let's start this video. Now first let's understand what is accounting. See here, accounting is very simple. See, in the company, what happens in a company, there will be lots and lots of financial transactions happening on daily basis, right? So there will be lots of financial data being generated. So many transactions are happening, so many bills, receipts, vouchers are creating, so many things are happening. So now here in accounting, what we do is, as an accountant, we record that data properly, that financial data. Yes, we record that data. Not only record that, we classify that data properly in a structured format, and then what we do is we summarize that financial data into meaningful format. That financial data which is being generated, we have to record that, classify that, and then summarize that properly into meaningful format. Why into meaningful format and how into meaningful format? See here, why? Because it has to make sense to the users of that financial information. Who are the users of financial informations? It can be management, it can be shareholders or the owners of the business, it can be the government, it can be creditors, the people who lend the money to the business or to the company, whatever it is. So these are the stakeholders, or what, the users of financial information. So this data has to make sense to them. Why? Because they can take meaningful and constructive proper decisions based on that financial data. Yes, so that meaningful format, if I tell you, basically it is what? Balance sheet and profit and loss account. The balance sheet will give us the information of the financial position of that company. All right, balance sheet consists of what? The capital, assets, liability. We'll come to that later. So all you have to understand is balance sheet gives us the financial position of the business, and then profit and loss account, or the statement if it's a company, then that gives us the financial performance of the company. Financial performance, what is the profitability, how well the business is doing, right? So this is the meaningful format. So what is accounting? Accounting is nothing but recording, classifying, and summarizing the financial data into meaningful format. That's all accounting is, right? So now let's see the accounting process. See here, the accounting process is very simple. Accounting process starts with the source document. Now what is source document? See here, what do you do in accounting? You record the data first, right? So to record any entry, to record any transaction, you need a source document. The evidence of that transaction. It can be a voucher, it can be a bill, it can be an invoice, whatever it is, any evidence. So that is called source document, a document, right? So based on that, you are going to make an entry, a journal entry in the journal book. All right, and then what you're going to do is you are going to create ledger accounts. All right, ledger accounts, and then from that ledger accounts you will get so many balances, debit balances and credit balances. We'll come to that later. All you have to understand is we create ledger accounts, and then from those ledger accounts we take all those balances and summarize them in one statement that is called trial balance. Source document, pass the journal entry, create ledger account, it is called posting, and then transfer all the balances to the trial balance, and then at last we prepare financial statements. What are financial statements? This thing only, balance sheet, profit and loss account only. So see here, profit and loss statement, balance sheet, and there are more also, cash flow statement and statement of changes in equity. This you will see later. So now you can understand this only, profit and loss statement and balance sheet, simple as that. So these are the financial statement that will be prepared at last. And the process from source document till trial balance, it is called bookkeeping. Okay, a normal accountant will do this job, bookkeeping. This is what bookkeeping is known as. From the source document till the trial balance, simple accounting job. So this was the accounting process, which takes long time. It takes long time to do all this. All right, so this was the accounting process. Now we have to understand the elements of financial statement, right? So far we have understood the meaning of accounting and the accounting process. Now we have to understand the 5 elements of financial statement. See here, in accounting what we have is we have only 5 things. Okay, always remember that. In accounting we have only 5 things, nothing more than that. Okay, there is no 6th thing, only 5. Yeah, and the entire accounting is based around this. All right, so the first is asset, expense, liability, equity or capital, revenue or income. Okay, only these 5 things are there. Clear? And these are also called as 5 elements of financial statements. Why? Because they are represented on the face of the financial statement. This expense and revenue, these 2 elements will be shown on the profit and loss statement, and then these 3 elements, asset, liability and equity or capital, this will be shown in the balance sheet. Okay, they go to the balance sheet and these 2 elements go to the profit and loss statement. So that is why they are also called as 5 elements of financial statement. Now we have to understand this properly in depth. So let's do that. Okay, let's understand the meaning of each and every item properly. Let's do that. Now let's see the meaning of the asset first. See here, an asset is a resource controlled by an entity as a result of past events and from which future economic benefits are expected to flow to the entity. That's what an asset is. Now previously we used to say that asset is something that the company owns. If company owns the land and building, then that's an asset of the company. Yes, but now the definition has been revised. See here, now asset is not something that the company owns, but rather something that the company has control on. Yeah, if company has control on something and there are future economic benefit from that, then that's an asset. Simple as that. Yeah, what does this control mean? See here, it can either be ownership, yeah, or if you can get machinery or whatever it is, whatever you can get on lease basis, yeah, by the way of lease agreement, then also it means you have control over that and you can use that and you can utilize the future economic benefit from that, right? What does future economic benefit means? It means that, you know, if you have, let's say you have machinery is an asset. Yes, so now that machinery you will use for the production or whatever it is, and then it will help you in the operations of your company and to generate the revenue, yes, to generate the income, isn't it? So that's what future economic benefit. Yes, so here control means what? Either you have ownership of that thing, then that's an asset, or you can get it on lease basis, then you have a control over that asset. Yes, so that machinery which you can get on lease basis can also be recognized as an asset. Yes, so an asset is a resource, yeah, controlled by an entity as a result of past event. Past event means that either you purchase that or you get it on lease basis. Yeah, there has to be a past event. You purchase that thing, then that's an asset for you. Yeah, because you got ownership of that, and from which future economic benefit are expected to flow to the entity. Always remember, okay, asset has future economic benefit. If you purchase the asset today, yeah, if you purchase the asset today, then for many years you will be able to use that in your operations of the company and you will get value in future. Yes, it is expected that you will get value in future. So that's what an asset is. Now let's see the meaning of expense. Expense. See here the meaning of expense. An expense is the cost of operations that a company incurs to generate revenue and from which no further benefit is expected. Yeah, expense is what? Expense is an expenditure that you incur, the cost. Yeah, cost of operations. Yeah, and from which no further benefit is expected. Yeah, the main difference between asset and expense is that, you know, in asset we get future economic benefit. Yeah, but here once you incur the expenses, that means you have taken the benefit already. The benefit is already taken. For example, yeah, at the end of the month you pay the rent. Yes, now are you going to get any more benefit from that? No. If you're paying 5,000 rent today, that means you have already taken the benefit. Yeah, if you have paid the salary of your worker, that means that person has already worked for you. Yeah, he's getting the salary at the end, you are paying the salary, so that is an expense for you. Expense is something, you know, the benefit of which you have already taken. Yeah, no further benefit is expected. That's the simple logical definition of expense. Okay, expense is the cost of operations that a company incurs to generate revenue. Yes, you are incurring these things, you are paying the rent, you are, you know, paying the electricity bills, you are paying the salaries of your workers. because the operations can be run smoothly and you will be able to generate a revenue from that. Yeah, yes, and from which no further benefit is expected. This is the main point. Okay, no further benefit. If you pay the electricity bill, that means you have consumed the electricity. Yeah, you are not going to get any more electricity from that money itself. Yeah, if you get an electricity bill of 2000 rupees, that means you have used that much of electricity. Yes, now you are paying that 2000, that means that's an expense for you. Now that 2000 you can't say give me back or something like that. Yeah, you are not getting any benefit anymore. You have already utilized the benefits. Yeah, you have already utilized the benefit. Clear? So that's what an expense is. Now let's see the meaning of liability. See here, liability is very simple. See, liability is a present obligation of the entity to transfer an economic resource as a result of past event. Now what does this mean? See, it's very simple. A present obligation. Right now there has to be an obligation to the entity. Your company has to pay something, do something, or abstain from doing something beneficial. Yeah, so see here, a present obligation of the entity to transfer an economic resource as a result of past event. There will be some past event. For example, you purchased 10,000 worth of goods, yeah, and you didn't pay. Then you have a present obligation to pay that person, pay your supplier. Yeah, so that is what the past event is. You purchase those goods. Yeah, now the present obligation is you have to pay in somewhere in future. Yes, and what you have to pay? You have to pay him cash. So transfer an economic resource. So that economic resource will be money, the cash you have to pay in future. Yes, so you're understanding? Yeah, so liability is a what? A present obligation of the entity to transfer an economic resource to do something as a result of past event. Yeah, it is a claim of outsiders on total assets of the company. Yes, if you owe money to your supplier, then that supplier, that creditor, he will have claim on your total assets of the company. Okay, so that's what a liability is. Clear? It's just an obligation, financial obligation of the entity to transfer an economic resource as a result of past event. You purchase goods on credit. Yeah, you didn't pay the money, so now you have to pay. So that's an obligation. What you have to pay? Cash, economic resource, something you have to give or you have to do as a result of past event. Past event is you purchasing the item, yeah, the goods. Clear? So that's what a liability is. Yeah, now that person, that creditor, will have the claim on your assets of the company. Yeah, the asset means the cash or whatever it is, but it will have the claim on total asset of the company. We'll say total assets. Okay, that's what a liability is. Then we have to see what equity is. Equity or capital. Now what does this mean? See here, it's very simple. Capital is the money that is invested by the owners of the business, right? Whatever money the owner brings into the business, that's called capital. Simple as that. But now you will be wondering, why do we have two names over here? You are saying equity or capital. Why two names? That's because it depends upon the different types of organization. If it's a simple partnership business, there will be few owners, right, who will bring in the money, and we can just call it A's capital, B's capital, like that. Yeah, whoever has brought the capital. And then if it's a sole proprietorship business, then we can just call capital. Simple as that. Yeah, but now why am I saying equity? That's because if it's a company, then in company we don't have few owners. No, we have thousands and hundreds and thousands of owners, right? Shareholders. We call them shareholders because there in company the capital is divided into small units of shares. Yeah, so that's share capital. Yeah, so it may be equity share capital or preference share capital, as the case may be. So that's why we call it equity. All right, it's just different names, but the concept, rule and meaning is same only. Okay, see the meaning over here, it's same only. Okay, whatever money that is brought in by the owners of the company, that's called capital. Yeah, either it's just capital or equity share capital or preference share capital. Simple as that. Okay, don't worry. So see the technical definition over here. It is the residual interest in the total assets of the entity after deducting all its liabilities. Yeah, so why is it called residual interest? Because the equity, the owners, what do they get? They get whatever that is left, right? Whatever that is left, that is what they get. Okay, see here, when the company wounds up, what the owners will get? The owners will get whatever that is left. Okay, first the liabilities will be paid and then their capital will be paid. So that is what is meant by residual interest. They have a claim, yeah, the owners, it is the claim of owners. If someone asks you what is capital, then the technical definition would be, it is the claim of owners in the total asset of the company after deducting all its liabilities. Why am I saying after deducting all its liabilities? Because whenever, if you remember the definition of liability, yeah, they also have a claim, the claim of outsiders. We have to pay to liability holders, right? Obligation, we have an obligation, we have to pay something, do something. So that has to be done first and then the claim of owners will come. Okay, so whenever there will be a liquidation or the company will wound up, first payment will be done to the liability holders and then to the owners. So that's why these people, the liability holders, will have first claim, these people, owners, will have second claim. All right, on the total assets only, total asset of the company, total asset of the company. Okay, so this is what equity share capital or just capital is. It is simply claim of owners in the total assets. Now we'll come back to this, okay, with an example to understand how does that mean, okay, the claim of owners in the total asset of the company. We'll take an example and understand it properly. Don't worry, we'll come back to this, but let's see the revenue definition first. All right, so did you understand what capital is? Simply whatever money that is invested by the owners of the company, that's capital. And the technical definition is they have a claim. It's a claim of owners in the total assets because the owners have a claim. Clear? Yes. So now let's see the revenue definition. See here, the revenue definition is very simple. Yeah, what is revenue? Income, simple as that. Yeah, it is the gross inflow of cash. Yeah, it's inflow, that's all. It's the gross inflow of cash. Yeah, either cash is coming in or receivables. Receivables means what? Receivables means someone has to pay to us. All right, yeah, someone owes us money, so they have to pay to us, so we are getting income, so that's receivables. Or other consideration, it can be, see here, other consideration arising in the course of ordinary activities of business, such as sale of goods. Yeah, if we sell the goods, then we'll get the money, right? Yes, so sales is our revenue. And then rendering of services, if it's a service business, then we will render the services. We will not make sales, we will render the services and we will get the money, etc. And also interest received, all these things, okay, other things also, etc. means, right, interest received, rent received, whatever it is, dividend received, whatever we get, whatever income we get, that's called revenue. Simple as that. Yes, so now let's see one example to understand practically, yeah, all these elements. Yes, now here we have the example. See here, let's say you have a sole proprietorship business, you are a single owner and you started your business with 1 lakh capital. All right, now this is the balance sheet. Yeah, here we take capital, liabilities on the left hand side, and on right hand side we take what? We take all the assets. Yes, so now what I said, you have a business and you started your business with the 1 lakh. Yes, so now 1 lakh means what? You have cash of 1 lakh now in your business. Yeah, yes, and you have invested capital, right? So here you have to show the capital 1 lakh. Clear? So now how is the cash our asset? How is it our asset? That's because, see the definition of an asset. Asset is a resource controlled by an entity. Do we have control over this cash? Of course we have. Yes, you invested money here, so you have control over that. Yes, and future economic benefit. Do you have future economic benefit from that? Of course you have. You can do whatever you want from this cash. Yes, you can invest it somewhere, you can do whatever you want. So you have complete control as well as future economic benefit is there. So this is your asset. Clear? Yes. And how is this your capital? This is your capital because you invested this money. Yes, and now you have claim on the total assets of your company. Now total asset of your company is 1 lakh only. So you have entire claim on this 1 lakh. Is that clear? Yes, that's what I said in the definition of capital, right? Yes. Now let's say you purchased a machinery to do business. Yeah, you wanted to do some production or something. Yeah, so let's say you purchased machinery of 20,000. Clear? Yeah, and this was a cash transaction. You paid cash immediately. So of course your cash will reduce. Yes, your cash will be now only 80,000 because you have purchased machinery of 20,000. Now what is this machinery? This is an asset of yours. How is it an asset? Because you have control over it, you own it, right? And you expect future benefit from it because you will use it in production or something and it will help you to generate income. Yes, future economic benefit is there. So this is your asset. Clear? Then let's say you wanted to invest in a huge project, so you needed more money, right? So what you did was you went to a bank. Yeah, you went to a bank and you got a loan of 40,000. Yeah, let's say you got a loan of 40,000. Now what will happen when the loan is sanctioned? Immediately two things will happen. One thing is you will get the cash. Yeah, you will get the cash immediately. Yeah, it will be your cash, 40,000 cash you got. But now there is an obligation that is being created now. Yeah, immediately obligation is being created that you have to pay 40,000 back to the bank, isn't it? So this obligation is called what? This obligation is called now liability, a present obligation. Yeah, present obligation. Now obligation is there, you have to pay to the bank. Yes, you have to. Yeah, what you have to pay? You have to pay them cash, transfer an economic resource, that's cash. Why? Because as a result of past event, what was the past event? The past event was you took a loan from them. You took what? You took a loan from them. Yeah, this was the past event. Yeah, present obligation is there, you have to pay, you have to transfer them economic resource, and that economic resource is cash. Simple. So that's what liability is. Yes, so now immediately you have to recognize on the face of your balance sheet that you have got a liability, and that liability is bank loan, rupees 40,000. Is that clear? I told you, right? Here we take all the capitals and all the liabilities. Yes? Yeah. Then here cash also has to be increased because you have got an asset also now. Yes? You have got your own cash also now, 40,000 from the bank. Yes, it's the bank cash, but now you own it. So it's your cash now. So 40,000. Yeah. So it will be increased. So 80 plus 40 is 1,20,000. So now the cash that is there is 1,20,000. Is that clear? Does that make sense? Yes. So you see this. Now what is happening? Capital, before you had claim on the total assets of the company. Yes. But now there is liability holder also, outsider also. Now this guy, this bank also has a claim on your total assets of the company. What is the total assets? See here, let's tally the balance sheet. 140. Yeah, 1,40,000 here. The capital and liability is 1,40,000. It will always be equal. Okay, 1,40,000. Yeah, 120 plus 20 is 1,40,000. So now you also have, I mean the owner, you also have claim on the total assets of the company. If you see the definition of equity capital, see here, it is the claim of owners in the total assets of the company after deducting all its liabilities, residual interest. Yeah, whatever that is left, that's yours. That is what is meant by capital, whatever that is left. So now what is left? What is left? If you want to see that, then simple. See here, the liability holders, they also have a claim. So their claim comes first, then your claim comes. Okay, the first priority goes to the liability holders and then the owners. Okay, so these people will have claim on the total assets and also you, but you will get only after deducting liabilities. Okay, your claim is only 1 lakh. So your claim is 1 lakh means that what? Total asset is 1,40,000. After deducting all its liabilities, it will be your capital. 1,40,000 minus liability 40, 1 lakh. 1 lakh is your claim. 1 lakh is your capital. Yeah. So what is capital? It is the claim of owners in the total assets after deducting all its liabilities. Yeah. After deducting the liability, whatever that is left, whatever residual interest is there, that's yours. Okay. That's the owner's capital. Is that clear? Yeah. So that is what it practically means. Yeah. Whatever that is left, that is the owner's. Okay, and the liability, what? It is a claim of outsiders on total assets of the company. Clear? So did you understand this practically? Simple. And what was the asset? Something that is controlled by the entity as a result of past event, and future economic benefit should be there. Yeah, you can do whatever you want with the cash. Yeah, you can do whatever you want with the machinery, and you can expect that you will generate income, revenue from this machinery. Yeah, you will use it in the operations. Yeah, and you will do business, you will sell the whatever you produce with that machinery, and you will earn income. Yeah, that's what an asset is. Machinery is an asset, cash is an asset. Clear? Now let's understand the double entry concept. Yeah, let's go there. Are you clear with equity, liability and everything? Yeah, simple. Yes, let's go to the double entry. Double entry. What is this double entry? See here, it's very simple to understand. In accounting, what we do is whenever we record the transactions, we follow this methodology that is called double entry, where we record two aspects of every transaction, and every transaction will have two aspects or two effects. All right, one effect will be debit and another effect will be credit. But now you will ask me, what is this debit and credit? See here, debit and credit doesn't mean anything. These are just two abstract terms that we use in accounting to represent something, okay? And that's something you will understand once you start building the concepts of accounting, yeah? When you will learn how to pass the journal entries and the balances of accounts, then you will understand what is this debit and credit, yeah? Directly, I cannot tell you what it represents or what it, what it means actually, yeah? Because it doesn't have like that meaning. If I ask you, what is plus, what is minus, can you tell me? You will say plus is add, minus is subtract, but what is add, what is subtract, what is that? It doesn't have any meaning itself. But if you tell me 2 plus 2 is equal to 4, yeah, then it makes sense. Similarly here, it will make sense when I relate this with assets, liability and everything, okay? So wait for that. Just remember that debit and credit, they just signify the duality principle or dual aspect, okay? We'll come to that. See here, we were in double entry. So in double entry, what it means that, every transactions have two effects, debit and credit, and both of them are recorded. Okay, accounting attempts to record both effects of a transaction or event on the entity's financial statements. Yes, and those two effects are, as I said, debit and credit. And every transaction will have one debit, one credit. Okay, and the effect of them will be equal, always equal. That's the duality principle. Yeah, that's what I said. Debit and credit represent the duality principle or dual aspect principle of accounting. All right, yes, so it will always be equal. Okay, the effects will always be equal. LHS equal to RHS. Clear? So this is what double entry is. Now I will relate this debit and credit with the asset and these 5 elements. Then you will understand what is this debit and credit. Okay, yeah, because you can't say debit is plus, credit is minus, something like that. Okay, most of the people do that. That's the biggest misconception. They say debit is good, credit is bad, or debit is plus, credit is minus, something like that. No, it's neither good neither bad. Okay, it's not like that. Yeah, it represents something else. It represents the duality principle. Okay, so we'll come to that now. So do you understand what double entry is? Yeah, see here, let me show you. See here, in this transaction, when you went to the bank and when you got a loan, what happened? This transaction had two effects. One effect was that you got the cash, 40,000. Yeah, this was your asset, isn't it? And then here what happened, immediately you had to recognize the liability also, because a present obligation was created. You have to pay. So a liability was created, right? So asset is there, liability is there. So this is the dual aspect I'm talking about. Yeah, when you purchase the machinery, what happened? When you purchase the machinery, there was cash, yeah, asset, this asset cash was reduced. Yes, and then this machinery 20,000, this asset increased, isn't it? So every transaction will have dual aspect. It will have two aspects. That is what is meant by double entry. And both the aspects have to be recorded. Yeah, we have got the cash. When we got the loan, we got the cash, our asset increased over here, and here what happened, the liability also increased. We have to pay to the bank, isn't it? Bank loan. So that's what, when you brought the money into your business, what happened? Cash increased, capital also increased. Yeah, so this is what, yeah, and one of them will be debit and another will be credit. Okay, so we'll learn that. So this is what is double entry. Okay, every transaction will have two effects. Yeah, do you get this? Yeah, bank example, simple bank example. When you got a loan, yeah, money is coming in, liability is also being created. Simple as that. So duality principle. Yeah, now let's see what kind of balances does these 5 elements have. Yes, these are the 5 elements, right? Asset, expense, liability, equity and revenue. So now you must know what kind of balances do they have. Yeah, it will help you to pass the journal entries as well as to do the ledger posting. So entire accounting is based on this, yeah, modern equation. And you will also be able to relate the meaning of debit and credit over here. Yeah, listen to this properly. So see here, asset always have debit balance. Asset always have debit balance. Why is that? See, I can't tell you. Similarly, how you can't tell me why sugar is sweet, why salt is salty, or if you remember high school chemistry, then why protons have positive charge and why electrons have negative charge. You can't tell me that. So similarly here, I can't tell you why asset have debit balance. It just is. Okay, that's it, period. Yeah, asset always have debit balance, expense always have debit balance. It's just a rule. Yeah, so they always have debit balance, these two things. Yeah, so whenever asset increases or you want to increase the asset, then you have to debit the asset. Okay, or when you want to increase the expense or expenses have been incurred, then you have to debit that. Yeah, and whenever you want to decrease any asset, let's say you have sold off the asset or the value of the asset is decreasing, then you have to credit the asset. Okay, simple. They have debit balance, you want to increase them, then debit them more. Yeah, if you have a sugary drink, you want to make it more sweet, then you have to add more sugar, isn't it? Just like that. Yeah, it has debit balance. To increase it, you will debit it more. To decrease it, you will do opposite, credit. Simple as that. Expense also, debit balance. To increase, you have to debit. To reverse the expense, sometimes what we do, sometimes we make an error. Yeah, expense never decreases. If you want to reverse the expense, then only you will decrease the expense by crediting it. Simple. Yes. Then liability, equity and revenue, they always have credit balance. Yeah, credit balance, always credit balance. So to increase them, what you're going to do, you're going to credit them. Simple as that. Yeah, equity also, capital also, equity or capital, credit balance. To increase them, you have to credit them. Yeah, revenue or income, whenever you get revenue, that means revenue is increasing, so you have to credit revenue. Yes, whenever they decrease, you have to do opposite, you have to do debit. Simple. This is the modern equation. Okay, so from here you can understand that, debit doesn't mean plus or minus, and credit also doesn't mean plus or minus. It can be both, it can be plus and minus also, because it depends upon the type of element. If it's an asset, yeah, for asset debit means plus. Yeah, and for expense also what, plus. Yeah, debit means. But for liability, equity and revenue, what, it is minus, isn't it? So you can't say debit is good, credit is bad, or debit is only plus, credit is only plus or only minus, something like that. Yeah, so just understand this modern equation. It's very simple. They have these debit and credit balances. To increase them, you are going to do whatever the balance is. Simple as that. Clear? Easy, right? Okay then. So here I'm going to end the video. Yeah, simple. So we saw so many things. We saw the meaning of accounting and then meaning of the 5 elements. Yes, what is asset, expense, liability, equity, revenue. Yeah, liability means what, they have claim on the total assets. Equity or capital means also they have claim on the total assets. And then revenue, inflow of cash. Expense means what, outflow of cash. Yeah, and then asset means what, asset means something you have control or ownership on, and you will get future benefit from that. Yes, and this was the accounting process. Source document, you prepare the journal entries. So yeah, in the coming videos we are going to see how to pass the journal entries, how to prepare the ledger account and everything. Okay, so stay tuned. So I will make a separate playlist, in that I'm going to upload all the basics of accounting. Okay then, see you in the next video. All right, bye.